We want to welcome back in Threadneedle Ventures founder and Barry. We also have Greg Daco, EY's chief economist. And guys, thanks so much for sticking around. So now we've heard from Powell himself, and I'm going to go to you first, just in terms of the market reaction to some of Powell's comments. What is your takeaway just in terms of what investor sentiment is at this point after we heard from Powell once again reiterating the fact that he doesn't think the economy is heading for a recession?
And he was completely clear and explicit on that. He finished by saying there's no sign of a downturn coming. So I think, go back to Jared's points, it looks as though the market is going to be flat. And it's kind of saying, Jay Powell met our expectations. Mm-hmm. When you really cut through all the verbiage, which I thought was reassuring, it's the market saying we've got it right.
Greg, you were listening to that presser. What, in your opinion, was Jay Powell's objective in that presser, and do you think he stuck the landing on it?
I think he did. Generally speaking, I think he did a relatively good job. I think there were three elements that I'll remember from this press conference. Number one, he talked about recalibrating monetary policy. That's what we were talking before, recalibrating closer to a neutral stance. Number two, he highlighted optionality. The Fed is not on a preset course. And number three, he has a lot of influence on policymakers. He talked about the decision process. I don't think most were necessarily on board to start the meeting with a 50 basis point rate cut. They mostly ended with this view that a 50 basis point rate cut was appropriate. So a lot of influence from Powell there.
Talk to us about the significance of that, and maybe can we glean anything about maybe what that means for future decisions? Because he was asked point blank, what is the data point that he is going to be paying most close attention to that's going to then help them determine whether they're going to go 25 or 50 if they do decide to cut at the next meeting? He didn't really answer it. He said that he was going to be data dependent, but I'm curious from your perspective, is there one piece of data that you think is most important?
That's the one thing I think was the key downside in terms of his performance, was the fact that he remained very much data dependent. One thing where he was asked whether this was a catch-up effect and whether he would have made a different decision had he had the July employment report in hand, he said yes, we might have. So that is an indication that there still remains a lot of data dependency that will influence the Fed's decision-making process. I wanted to see a little bit more of a forward-looking perspective and where we're headed and how fast we're headed. There's still a lot of data dependency in his speech.
Sure. And let me get your take on the market reaction. So we were up, we were down, now I'm looking, we're back in the green. What do you make of it?
Well, I think the market's just trying to figure out what this really means. They're still interpreting whether there's no recession outlook. As credible, I think it is. The one piece of data I did hear called out was wage inflation. As I listened to the presser, he did say wage inflation is above where perhaps we would want it to be in order for our 2% overall inflation level to be hit. So I think that's one I would be looking at, both from a market perspective, but also from an economic data point perspective. I think it's important.
And another piece that he was asked about, he's asked about so many things, but one thing that stuck out to me was some of his commentary surrounding housing. And I'm curious, Greg, from your perspective, just your assessment of the housing picture now that we do have a 50 basis point cut, is that really going to move the needle at all within the housing market?
Well, I think one key element in this decision was the asymmetry of risks to the upside and downside. If the Fed had done less than expected, the risk would have been a repricing of rates higher. So you would have seen mortgage rates actually go the opposite direction. I think it's very encouraging not to see much reaction in the markets because essentially the Fed did what was largely expected over the last couple of days. The risk would have been that yields rise rapidly and that hits mortgage rates, consumer rates, auto loan rates, and that deters private sector activity. So the risks were not balanced in terms of the Fed's decision.
Let me ask you, let's say, you're at a barbecue this weekend. You're talking to your friends and family.
Yeah.
They say, Greg, I heard the Fed did some kind of historic supersized cut, and they ask you, but what does it mean for me, actually, in my life as a consumer? How would you respond to that?
It's very interesting because that's a question that I actually get a lot of.
I'm sure, yeah.
You actually have a fairly limited effect of the Fed's easing or tightening because it's 25 basis point increments. If you look at adjustable mortgage rates, they based off of the Fed funds rate plus a premium. So that 25 basis point, 50 basis point doesn't do a whole great deal in terms of stimulating or cutting economic activity. Same for consumer rates and auto loan rates. But if you have a broad rise in rates of 50 basis points or higher in the opposite direction, that can rapidly deter economic activity. So think of 30-year mortgage rates, which are based off of longer-term yields. They could have risen much more, and all of a sudden, first-time home buyers might have been on the sidelines saying, hey, I'm not going in, I'm waiting a little bit more.
And one of the things that we were talking about going into this presser from Powell was whether or not this was a proactive move, whether or not this was a reactive move, and maybe where the recession risk lies. Just based on his commentary there, have you at all been swayed in one direction or the other?
I haven't, and he was explicitly asked the question whether this was a reaction to the change in the market's expectations, and as he did on the political question, he said, no, we're independent, we're data dependent. I think if there's one thing I always find disappointing about these presses, nobody asks the question, are you guys going to start using different data sets? Right, and Greg, you made this point beforehand, everything is backward looking. We're in the age of incredible data collection, incredible technology. What is the Fed doing, like the ECB is doing, which is publicly talking about what different kinds of data can help them be better forward looking? I'd like to hear that.
That's something you think that they should be doing?
I think they should be doing it, we should be asking about it, and it should be an open discussion.
What do you think of that, Greg?
Yeah, I think we have a great amount of data. They're starting to use some private sector data. They've Powell has referred explicitly to the Indeed wage tracker data, for instance, as a good measure of wage inflationary pressures. That's part of the reason why I think he's not seeing any additional wage pressures coming out of the labor market and inflationary pressures coming out of the labor market. So there is that move, but it's very gradual, and I would fully agree with you that it's not rapid enough in terms of the new data sets that are available.
Greg, Ann, thank you so much for joining the show today. Appreciate it both. Thank you.